Did the Grinch steal the Christmas rally through margin hikes? Just as silver was going red hot, the Shanghai exchange and the COMEX exchange raised margins on futures contracts, which broke the silver rally, disappointing thousands, hundreds of thousands, millions of silver investors around the world, causing a lot of finger pointing. Was it the Grinch stealing the rally? Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. In this short video, I'm going to explain what exactly has happened over the last couple of weeks with the silver price and the margin hikes that we've gone through to put into perspective what has actually happened. Here's our contact information if we can help you in the physical arena. Let me get on with my margin hike explanation. So first of all, this is about a 1-week chart of the silver futures contract going into, during, and after the Christmas holiday. Now, what typically happens, especially when Christmas is on a Thursday and the markets are open on a Friday, we get very thin trading because most people are on vacation. So that's when the market is most susceptible to being bullied. Keep that in mind. So what happened? Well, silver's under $70 an ounce going into Monday the 22nd. Tuesday the 22nd, we get a little blip over 70 and then a little correction. And then going into the Wednesday the 24th, Christmas Eve, silver breaks over 70 to get to about $72 an ounce. Then we close for Christmas Eve and we're closed for Christmas Day. But when we reopen, the market gaps higher. And then on Friday the 26th, silver rockets higher to $82.67 an ounce. And then the market closes for 2 full days, Saturday and Sunday, going into the Sunday night Asian reopen. And everybody in the world, all they can think about if they're a silver investor is $82.67 an ounce silver. And then the market opens and what happens? Silver tanks. And then we go into Monday and silver tanks again. And this is when the margins were raised, leading everyone to believe that the COMEX exchange is the Grinch and has stolen the rally from them. I got this off of Zero Hedge, and this shows exactly where the margin hikes kicked in on those 3 occasions. When the Sunday market reopened in Asia, the Shanghai Gold Exchange raised margins there, breaking the market down. Then the COMEX exchange announced a margin hike on Monday, December 29th, when a lot of people are still on vacation, making wiring margin money a little hard to do. And then we got another margin hike from the COMEX exchange on December 31st. So let's drill down a little bit further on what actually happened. This is a chart that goes back to 2021 and shows you where the COMEX margins have been relative to silver and also relative to percentage value of silver, which is that green dotted line. So earlier in the year, the COMEX margin was about 11,500. Then it was raised to 15,000, where that first black arrow is. We had a little short hike, probably $500. I'm not sure exactly what it was. It was immaterial. Then we had a hike up to $20,000. That was actually December 12th. Then we had a hike to $22,500 and then a hike to $25,000. And now what's not indicated on this chart, on January 6th, we've got another hike to $32,500. So the margin has more than doubled from $15,000 to now $32,500. But what else has more than doubled? Well, the price of silver. And this is really where the rub is that most people don't understand. For most of this period of time, this year, the COMEX exchange has maintained a margin percentage on the value of a $5,000 silver contract of about 7.5%. But if you have a percentage of value that you're trying to use as a margin, and you see a price increase in dollars that's basically a double of the price, which is what's happened to silver, to maintain that 7.5% margin value, you've got to double the margin too. And that's what really has happened this year. We've seen the margin double with the silver price doubling as well. Let's talk about this for a moment. So any person who buys or sells contracts on the COMEX exchange is used to margin calls. First, when you buy or sell a contract, you have to put up that margin money, which is the cushion that the exchange holds to protect the exchange from market price changes and market volatility. It's both. Value change and volatility increases or decreases. That's what the margin money is for. And if silver is $40 an ounce, a 5,000 ounce contract has a fundamental value of $200,000. Now, a 7.5% margin on that is $15,000, which is where the exchange was earlier this year when the value of silver was about $40 an ounce. Now, so you buy the contract, $40 an ounce, you go long, you put the $15,000 in, and the silver price goes up $5 an ounce. $5 an ounce times $5,000 is a $25,000 profit. Now the COMEX has $40,000. So you can pull some of that money back out and still maintain a $15,000 margin, because that's the margin requirement. Contrarily, if the value of that contract drops $5 an ounce and you're long, you bought at 40 and it drops to $35 an ounce, now you've got a $25,000 loss with a $15,000 margin. Now your margin is a negative $10,000. So what you actually have to do is to put that full loss into the COMEX exchange, or else the COMEX exchange is going to lose that money that you're short. So now you've got to put $25,000 in, making your margin, in essence, $40,000. And this is what all futures traders are used to. Whether you're long or short, depending on where you bought or sold, are value changes where you can either harvest some profits or have to put up extra margin cushion to maintain that same cushion for value and margin changes, right? So let's make sure that we understand that. And when the COMEX is forced to raise margins like they have done, it's because of the value increase. It's not to penalize the small investor. It's not to shake the tree on purpose so that the big guys, the bullion banks that have virtually unlimited financing and who margin calls are somewhat immaterial to, don't profit on the back of the little guy that has a much harder time stomaching a margin increase. That's not what this is about. And if that's how you've been led, you have been misled. My job is to present to you the facts. My goal is to have you believe in the integrity of the message that I'm presenting to you. So let's drill down just a little bit further on this so you can see in more granular detail what exactly has happened over the last couple of weeks in reality. Let's take a look at this 6-month candlestick chart that explains to you how the silver price has increased and the volatility has increased with that price increase. I've got 3 separate sections here delineated on this chart. The lower one is between 35 and 39.50 per ounce for silver, or about a 10% spread in percentage and less than $5 in dollars. Then silver moved up and moved into a $46 to $54 price range, which is an $8.40 price difference and about an 18% volatility. And then the third section is just over the last 2 months, we've seen silver move from $60 to $82 an ounce, which is about a 35% volatility, or $22 in dollar terms of a spread. But in essence, we have support for silver at about 70 and resistance at 82, which makes that about a $12 spread, still higher than the lower spread before, and a 17% volatility, or about the same percentage of volatility in the medium level. So that's pretty obvious to see, right? What's also happened is as the COMEX has raised margins, first on December 12th, then the 29th, and then the 31st, we've seen the market take a hit. Everything you've seen up to this point, I taped on Friday, January 9th. This is a revised update as of now Wednesday, January 14th, because we've had two new developments in the marketplace that are pretty big. Number one, silver's punched even higher to as high as $92 an ounce. And we've had a change in COMEX margin policy, which is why I'm updating this. So this is a candlestick chart that goes back 3 months that labels when the CME first raised margins on December 12th to 20,000 and how the market popped on December 26th on Friday when that thin trading, just like it popped on the day after Thanksgiving over 54.40 for the first time, again in thin trading, both times when the markets had less players in it. It's been driven sharply higher, which is very unusual. But let's go through the rest of these margin hikes. First, the Shanghai exchange raised margins on December 29th after silver had punched all the way up to 83.62 intraday. That's Sunday night. Monday morning, the COMEX raises margins at the same time, now to 22,500. Then on the 31st, the COMEX raises margins to 25,000. Then on January 6th, the COMEX raises margins to 32.5. And you can see every time they've raised the margins, we've had a downdraft day. The biggest one following the initial margin hike increase on December 29th, and then a more moderate downdraft with still a lower price on the 31st. And on this last margin hike in dollars on January 6th, the market absorbed that much better, and the market keeps moving higher. So the market is absorbing these margin hikes. But the COMEX has finally done the right thing, and they announced this just yesterday. They're increasing the margin, not from a dollar standpoint, but to a percentage standpoint, which will make this a lot simpler going forward. Because when you have a sharply moving market and you're trying to maintain a percentage of margin in dollars, then you're always adjusting the dollar amount. But if you do it in a percentage amount, it makes the calculation much easier on a daily basis. So let's drill down on that a little bit further. But the point here fundamentally is this market's really strong. It keeps advancing higher and higher. It's $92 today on the high. And it's absorbed these margin hikes really well so far. So here's what the COMEX margins looked like in dollars going back to earlier in the year when the silver price was $39.50. We had a 7.5% margin then on a 5,000 ounce contract with a value of $197.5. 7.5% was $14,812, and they had the margin at $15,000. What you can see is how the silver prices increased. They've increased the margin in dollars every time to try and equal that about 7.5%. But now they've made a material change to just putting the margin requirement in a percentage. And this is what it'll look like now. So if you got $85 silver, a 5,000 ounce contract has a value of $425,000. A 9% margin is $38,250. At $90 an ounce, it's $40,500. At $95 an ounce, it's $42,750. By changing the margin to a percentage instead of a clumsy dollar amount, margin calls will now be made on a daily basis based on value and margin. So this will make the movement of margin fluctuations much more granular than they've been with this clunky, we're going to raise it 5,000, we're going to raise it 7,000 as the silver market moves higher. It takes the knee jerks out of the equation. which will make the market run more smoothly and be less susceptible to some of these knee jerks we've seen over just the last couple of weeks, as the COMEX has been forced to raise the margin higher in dollars to raise the percentage of value back up to where they needed it to be to maintain that orderly cushion. So this is going to make things a lot simpler going forward and a lot more granular in adjustments, I think. So the market will run more naturally to where it needs to run, and will be adjusted for margin on a daily basis instead of these knee-jerk hikes that they've thrown in, ad hoc as they've been forced to. So this makes the whole situation a lot simpler than it was. The market remains red hot. Silver just keeps punching higher on a daily basis. And now we've absorbed those higher margins. We've kind of shaken that tree. And as I've said before, that wasn't to penalize the little guy. That's to run an orderly market so that the exchange has a proper cushion to guard itself against trading participants' losses, so the exchange doesn't incur those losses. That's what these cushions are for, to run an orderly exchange that's properly capitalized, as the silver value has more than doubled and almost in just the last 6-7 weeks by itself. So that's our video. Thank you so much for your time today, and good luck out there.